Okay, so we are ready to start chapter 2, because chapter 1, again, you just did the little Learn Smart, adaptive learning plan in it, and there's no homework on it, since it was really just an introduction to what cost management is. Chapter 2 really starts getting into the more fun stuff. For those of you that are in managerial or recently took managerial, it probably looks really familiar, right? So a lot of this first chapter is really just a review of managerial. They just kind of push some different terminology all into one chapter. But we're really reviewing, what a cost system is, how to trace costs in a manufacturing company, and, like the activity drivers or cost drivers for costs and things like that. So we're really just going to get into the practice and kind of go over a review of how we track those different costs and the classification of costs in manufacturing. So again, the biggest difference from going from financial to managerial or cost accounting is financial, we don't use the word cost at all, do we? We say expenses. So those expenses are things that we've already incurred. So in financial, when we talk about an expense, it's something already incurred, and then we just need to pay it. Costs are usually like future things. So we're looking at, we can plan and budget, because managerial or cost accounting is more about planning for the future, decision making, and all of that. It's very decision making driven. So that's kind of where we're starting out, just looking at, again, going over manufacturing costs, the cost flow. So we gave you 2 pieces of paper, and these are both out on Canvas. The first one is just kind of going over different cost terminology to get us back into thinking manufacturing. So, again, we're looking at providing reports to like production managers, so they can look at, well, why is my production cost for material so high? Do I need to find a cheaper material, or are we overusing, are we wasting material? So all of these reports are for internal use and helping different department managers manage their costs and plan better for the future. So just as a review, I know some of you, it may have been a while since you've had managerial, or you could be taking it right now, right? So product costs, you have direct materials, direct labor, and factory overhead. So those are your 3 product costs, or manufacturing costs. They use those terms kind of interchangeably. So those are the costs directly tied to the product. I kind of skipped down a little bit, but period costs are marketing and administrative, selling, those sorts of things. So it's good to look at just categorizing one over the other at first. So product costs are your cost of goods sold costs. So materials, labor, and overhead. Period costs are selling and administrative expenses. So sales, salaries, sales commissions, marketing, and then anything tied to the office, like your vice president's salaries, office administration salaries, computers and buildings, all tied to the office. So we really have to kind of separate those 2 out. And that's important. We kind of see down at the bottom for like our income statement, we want to look at just our gross margin, our profit margin. That's when we take, our sales minus cost of goods sold equals gross or profit margin. So that's just looking at a product cost or manufacturing cost standpoint. Whereas then we subtract out the period costs to get like our net income. So, they're all expenses, they're all costs associated, they're all coming out of profit, but we want to look at product costs versus period costs. I'm going to separate them out. So with our product costs, again, materials and labor, those are ones we can directly trace to whatever the product is we're making. So direct materials, if we're making guitars, it would be like the wood and the strings and things like that to make a guitar. Direct labor would be the actually assembly factory workers that are working on it. And then everything else is manufacturing overhead or factory overhead. So supervisor salaries, indirect materials, like, anything we can't really calculate per product, so it could be like oil and little small parts that we can't calculate directly. Indirect labor would be like the supervisor salaries, things like that, maintenance workers in the factory. And then your other factory overhead costs would be things like rent, lights, depreciation on equipment, equipment maintenance, things like that. So all of those costs can be tied directly to the product. Some, or not directly, sorry. All of those costs can be tied to the product. Direct materials and direct labor are direct product costs. Factory overhead are all indirect costs, okay? And then it just breaks it out, gives you more terminology, right? Prime costs is direct materials and direct labor. So prime costs are direct costs, okay? And then conversion costs are just the costs associated with taking raw materials and converting them into a full product. So conversion costs are labor and overhead, okay? So we're going to focus on that and keeping track of, in a given month, what our costs were, okay? And we'll look at that here in a minute. And then further, we'll also start talking about variable costs versus absorption costs. So variable production costs are anything that changed with the level of production. So if we make more guitars, we're going to need more materials and more labor, right? So those are variable costs. And then we'll also have variable overhead associated with that. And then your only like fixed cost is going to be fixed overhead, like rent, utilities, depreciation, stuff like that, okay? And then when we're looking at full absorption costs, this is the same as the product cost, so it's going to be all of our costs. Full absorption costs is all variable and fixed product costs. And then when we're looking at beyond just your full absorption product cost, our full costs are every cost, all of them, period, and product costs, okay? So just to kind of give you an idea kind of there where the different costs we're talking about in this chapter. And then that second sheet I actually made for my managerial course, but then I thought, well, you guys can use it too. It's the same cost flow. So it's really just getting back to T accounts, which I find easier to work in when we're dealing with cost flows, because the biggest thing to kind of review with managerial concepts is when we did like merchandise accounting and financial, we had one inventory account that we used, right? We purchased inventory, we sold inventory all out of one account. Manufacturing uses 3 different inventory accounts. So we're going to have materials, raw materials, which you see on here. We have a work in process, and then we have our finished goods. So those are all 3 inventory accounts. So really, a lot of the statements that we're doing in this class are really balancing those 3 T accounts. So I thought, well, it'll be helpful to actually have the T accounts and see those along with the statements, so that way you can kind of visualize and know how to easily calculate it, okay? So that's kind of where we're going. And the rest of your notes just kind of give you example of statement of cost of goods manufactured, which we'll talk about, statement of cost of goods sold, and an income statement. So those are the things we're going to do in class. So when you're in Canvas, if you kind of scroll down a little ways through the first unit, under that Chapter 2 Adaptive Learning Plan, there's a Chapter 2 practice set. Chapter 2 practice set. So go ahead and click on that. And that'll open up in Cengage. And we will get to going on our practices. Okay. Okay, so this first one says product costs. We have Petro Frozen Foods produces frozen pizzas. For next year, Petro predicts that 50,000 units will be produced, and here's our total costs. So again, these are all predicted costs. Materials, labor, and then they separated out both fixed and variable overhead. So they want us to calculate the prime cost per unit. Well, again, what 2 costs make up prime costs?
Direct materials.
Very good. Direct materials and direct labor. Well, they want it per unit. So what do I need to do to calculate that? Divide it. Yeah, exactly. So we have total costs here. So I can add those 2 together, right? 120 plus 60. So my full prime costs are 180,000. And we predict 50,000 units. So we just divide. So what is my prime cost per unit? $3.60. Very good. Make this bigger. So this first one's a little bit easier, right?
It's going to say practice set.
Yes. Yeah, I should say chapter 2 practice set. It's easier if you go like straight through Connect or through Canvas, because let's click on the home page. That way you don't have to find it in Cengage. Maybe spelled it wrong. Right here. Yeah. For some reason, when you go to Cengage and trying to find it, they put them in different order, and it's like ridiculous. So. Okay. So our prime cost per unit is $3.60. Well, number 2, we're really doing the same thing now. It's conversion costs. So what are my 2 conversion costs? Well, really 3, I guess. Labor and overhead. Good. So I would add up my direct labor plus both variable and fixed overhead. Conversion costs are all overheads. Okay. So I add that up and then divide by 50,000 again, right? So what's my conversion cost per unit? Very good, $6.10. Okay, $6.10. Number 3 is total variable cost per unit. Well, what are my variable costs? Very good, bless you. Direct materials, direct labor, and variable overhead. Okay. So again, we're doing the same thing, right? We're adding up all our variable costs, so materials, labor, and overhead. So what is my variable cost per unit? $4.10. Very good. And then number 4 just asks for the total product cost per unit. So what's my total product cost per unit?
$8.50.
Very good, $8.50. So in that case, it's all 4 costs, the total product costs. Those are all product costs, okay? So that's really just kind of getting us into the flow of recognizing those costs and being able to do unit costs. Number 5 gets into some what ifs, though. It said, what if the total number of units increased from 50,000 to 55,000, but all the unit variable costs stayed the same? So unit variable costs all stay the same, but we increase production by 5,000. What would happen to total direct materials? It would go up, yeah. If we're increasing production, then all of our variable costs are going to go up, right? Okay. So it's going to increase. How much is it increasing? 10%. Okay, yeah. So we have a 10% increase from 50,000 to 55,000. And then direct labor is also a variable cost, right? So it's also increasing. And it's the same increase. What about variable overhead? It's the same, right? These are kind of easy after after the first one. You're like, okay. Total fixed overhead.
It doesn't change.
Very good. Total fixed overhead doesn't change. I mean, it's fixed. So fixed overhead does not change. No change. What about the unit prime cost? What happens to I heard up, down, same. I heard all 3, right? Okay, well, let's think about it. It's a unit prime cost. What is my unit prime cost? Materials and labor, right? And it's the unit cost. Will the unit prime cost go up or down? We're talking about the price per unit. No, it won't do anything. It won't change.
So if you go to 55,000, it won't change?
Your unit cost won't. So the total prime cost will change, right? So what we're looking at, this cost, like our prime cost per unit, the $3.60, it will stay the same. We're going to increase our total materials and our total labor costs, because to calculate it, we would take, materials $360 per unit times 55,000 now instead of times 50. Okay, so our unit cost, our unit prime costs don't change at all. Okay. It is a trick question. And so is F. Now we're talking about unit conversion costs. So conversion cost is labor and all of our overhead. So will it change? Yes. And it will go up. And why? What cost is changing that will make it go up?
What
the unit conversion costs decrease?
Oh yeah, you're correct. Yeah. Unit conversion costs decreases. Yeah. Exactly. Very good. So fixed overhead, that's the tricky thing with like fixed and variable costs, right? With variable costs, they stay the same per unit, but your total variable costs increase with production changes, right? With fixed cost, they're the same per month regardless. So the unit fixed cost will go down the more we produce. So with unit conversion costs, because there's a fixed cost component in there, we're now taking that total fixed overhead and divided it by 55,000 instead of 50,000. So the fixed cost per unit is going down. So it's causing our whole conversion cost to go down. But by how much? Less than 10%. Good. Because it's not every cost. Your labor and your variable overhead are staying the same. So out of all three of those conversion costs, only that fixed portion is going down. Fun and tricky, right? It's kind of like supply and demand curves almost. We won't graph it though, no worries. If that were the case, if we increased production to 55,000 units, what would our product cost per unit be in this case? Very good, $8.10. And how did you calculate that? There's a couple ways, but.
I took all the variables, multiplied by 10%, and then added all of them back in.
Yeah, there's a couple ways to do it. You can increase your variable cost by 10% and then add back in your fixed. So in that case, you would take, scroll up here. You could even just, your variable cost, 120 plus 60 plus 25, add all of that, multiply it by 1.1 to get your total increase. And then add in your fixed. Okay, I'll write it on the board.
Where's the 1.1 come from?
110% of its original value. Yeah, including, so that way you don't have to. Does that make sense? Yeah. So yeah, you can do 120 plus 60,000 plus 25,000. I'll put it here, down here, times 1.10%. And then add in your 220 in fixed. And then divide all of that, because I'll do my parentheses, right, by 55,000. And that'll get you 810. And you said you did it separating out your prime cost. Yeah, and that's the one way I was like, okay, well, all I need to really calculate now is my fixed overhead per unit, because all the others stay the same. So another way to look at it is my variable cost per unit didn't change, right? It stayed the same. Variable cost per unit stayed the same. So to figure it out, another way to do it is to just take my fixed overhead and divide it by the total units. So I get a fixed overhead of $4 per unit, and then I add in my variable cost per unit of 410, and I get the same answer. So it depends on how your brain works. Last semester, my brain worked like this, but today when I was doing it, I did it like this. I don't know why. So this one's a little shorter. It just depends on how you look at it. You know, there's probably another way too. Any questions on that? Alrighty. So it's just, again, getting us acclimated or reacclimated to understanding fixed and variable plus, you know, prime, conversion, all of that. Okay. The second one, as you can see, it's the same beginning information, same company, and they just don't show us direct materials, but they give us our other costs. And it says, next year, Petro expects to purchase $119,300 of direct materials. And it gives us projected beginning and ending inventories for both direct materials and work in process. And it says, prepare a statement of cost of goods manufactured in good form. Okay, well, in good form just means that it's in the proper form. So again, we can do this and just follow the notes that I gave you for the statement of cost of goods manufactured, or you can actually put it in the T accounts too. Again, sometimes it helps to kind of see the flow through the T accounts to know what we're doing with the cost of goods manufactured, because really what we're doing is balancing our work in process T account to get to that number. So I'm going to keep track of them. When we do a later one, sometimes it just makes it make more sense, all the different calculations. So I just like to set up my accounts. Materials. I think all we really need are materials and work in process for this one. Okay. So our manufacturing flow is we purchase raw materials. And of course, that's a prime cost. And we know the problem is, though, we can't easily trace costs because we always have these beginning and ending balances. If we didn't have beginning and ending balances, well, we could just say, well, what were the materials we purchased and how much labor did we use? And calculations would be really nice and simple. But the problem is we know everything we put into process in the period, are we going to finish all of those? No. In an ideal world, that would be great. But we know that that's not true. So there's going to be some leftover materials, labor, you know, all of that. There's going to be some leftover things that are unfinished. And then everything that's finished isn't always going to be sold. So there's always going to be beginning and ending balances. So that's kind of why we have to trace all these costs. So materials shows a beginning balance of $5,600. And I'll go ahead and put the ending balance. The ending balance is $4,900. And then work in process has a beginning balance of $12,500. And an ending balance of $14,600. Okay. So I like to put in the knowns. So what did they tell me? They told me we expect to purchase $119,300 of materials in the period. Well, those purchases get debited to materials. These accounts are both inventory accounts, so they increase on the asset side. They're assets. They increase on the debit side. So we have purchases. Purchases are $119,300. Okay. And then as far as work in process goes, the costs that flow into work in process are direct materials, which we'll have to calculate, direct labor, and factory overhead. Okay. So those are all of our costs flowing into work in process. Well, we're going to calculate materials used and put into production in our statement. Direct labor they gave us, right? 60,000. Factory overhead is given, 25,000 plus 220,000. So 245,000. Okay. So our goal in this statement is, first of all, to figure out materials, how many materials were actually used in production, like put into work in process. So we're trying to find this and this. It's the same thing. And then we're also trying to calculate this right here, cost of goods manufactured. Okay, so those are our goals. Well, I can do that before I put it in statement form, but we'll go through and do it one at a time. So again, our first step is to figure out the materials used in production. Okay, so what we need to do is really balance this T account. So what we're trying to solve for is this. What would I do to get this number, the credit to materials? Good, you'd start with adding the debit side, right? So I'd add those two together. So what's that?
124,000.
Very good, 124,900. So that tells me all the materials I have, right? All the materials available for use, okay? And then what do I do? Very good. I'm going to take this, the total debits, and subtract out the ending balance. So that one's actually pretty easy, right? 120,000. So that tells me what was used or placed in production. That goes right here. Okay.
I'm sorry. Oh, 120,000 that was used.
Yes. So we had total materials available of 124,900. And when you subtract out that ending balance, that gives you what you used. Yeah. We're basically just balancing our T account like reverse, right? So that's really the first little step, because what we just calculated was direct materials used in production. So now we just put it in statement form. So we start with beginning inventory. Beginning inventory, 5,600. We added in our purchases, which was 119,300. We added those two up to give us total materials available, 124,900. And then we subtracted out our ending inventory. I like to show the minus. It won't count it wrong if you don't put the negative in, but it helps me visually. So we subtracted out our ending inventory, so direct materials used in production, 120,000. So then we can kind of see in our statement, the next thing we want to calculate is total manufacturing costs added. Well, now we can do that. Okay. What we would add up then for manufacturing costs added, we have materials, labor, and overhead. So I'm going to add in direct labor of 60,000 and manufacturing or factory overhead of 245,000. So I'm just adding up these three first. Okay. Which is what, 425,000. $425,000. Well, again, I'm really just balancing my work in process account then. Okay, same thing I did with materials. So I need to calculate my credit. So I need to add up all my debits. So I would take that 425,000 plus the 12,500. 437,500. That's going to be adding in beginning work in process. Adding in beginning work in process of 12,500. I guess they skipped the subtotal. And then we're going to subtract out the ending work in process. So minus 14,600. So 437,500 minus 14,600. What's my cost of goods manufactured?
422,000.
Very good. 422,900. Okay, so that's just, again, I like to show it in the T accounts too, so you can see the visual of what's happening in the inventory accounts. You could do the statement, obviously, without doing the T accounts, right? But when you have it together, and especially sometimes, it just makes it a lot easier. Or if you need to calculate cost of goods manufactured and you don't have a statement to complete, this is a good way to do it. So then the second half says, what if the ending inventory of direct materials, so this right here, the ending inventory, increased by $2,000? So what if ending inventory, instead of being 4,900, was actually 6,900? Well, that would affect right here, right? This would be a minus 6,900. So what would happen to direct materials used? It would decrease. Very good. By how much? 2,000. How about my total manufacturing costs? Very good. Decrease by 2,000. And cost of goods manufactured. Exactly. So if my ending balance was higher in direct materials, obviously that's going to cause all of my costs to go down because I'm subtracting out 2,000 more out of those costs. Okay. Any questions on that one at all? All right. On to the next one. So on the next one, as you can see in our practice, the numbers are all static, so all the numbers are the same. I won't lie and say that's the same on your homework. Your numbers on your homework will be different, so I apologize. It makes it a little bit more work, I know. And in our case, we have the luxury of being able to use the numbers we worked in last example. So this is the same stuff, okay? All the same information. But now it says prepare a statement of cost of goods sold. Well, when we're doing cost of goods sold, I didn't give myself much room. But basically what I'm then balancing is my finished goods account. Okay, so we only have one more account that we have to deal with. So with finished goods, we are going to start with the beginning balance, just like we did on the other two, and have an ending balance. The cost of goods manufactured is what gets debited. It flows into finished goods. So when all of these get finished, they go into the finished goods inventory account. And they tell us, let's see, up above the required stuff, it says beginning inventory of finished goods is 42,500. And ending is 34,000. Okay. So to calculate cost of goods sold, we're taking beginning finished goods plus the cost of goods manufactured minus the ending balance. Okay, so we're just balancing the finished goods account. So again, on this one, because our numbers are the same from the statement of goods manufactured, we already had this number. On your homework, you're going to have to calculate cost of goods manufactured before you can do your statement of goods, cost of goods sold. So that's when you can just do the two T accounts, you know, put all the information in, balance them, and calculate your cost of goods manufactured. Okay. So statement of cost of goods sold, we start with cost of goods manufactured, which again, in this case, we already calculated for $22,900. We add in the beginning balance, which is $42,500. $42,500. That tells us our total cost of goods available for sale. How much is that?
$465,400.
Very good. $465,400. So that's all the items we had that were finished and ready to sell. And then we subtract out our ending finished goods balance of $34,000. And that gives us cost of goods sold. So what's my cost of goods sold?
$431,400.
Very good. $431,400. And that's cost of goods sold. So your journal entry there would be a debit to cost of goods sold and a credit to finished goods. Okay. So once you have that cost of goods manufactured, your cost of goods sold statement's pretty easy to calculate. But again, just remember on your homework, you'll have different numbers, so you'll have to calculate that first. What if beginning inventory of finished goods decreased by 5,000? What would be the effect? It decreased then. Very good. It would decrease by the 5,000, right? Any questions on that one? It's pretty quick when we already have the cost of goods manufactured, right? Okay. Our next one, same thing. We're doing an income statement, same numbers. So again, this is where it will be longer on your homework. And I apologize there because then on your homework, on this one, you'll have to calculate your cost of goods manufactured. Really, you'll have to go all the way through and calculate cost of goods sold. Megan. So again, if you use your T accounts, though, it really won't take you that long, right? I mean, heck, sometimes I just type it in Excel and have it calculate it for me, and it's a little faster. Okay. So on this one, what we're doing is an income statement now. So same information. We have all of our data on the board. So we're going to assume on your homework, you've done all of this. And now we're to the statement part. So new information, he expects to produce 50,000 units and sell 49,300 at a price of $12.50 each. Same finished goods information. And then he just tells us total selling expense is 26,000, administrative expense 134,000. So they want us to do an income statement, and as you can see, they want to do it with our percent of sales on here as well. Okay. So when I start an income statement, what's the first thing I put on?
Sales.
Sales. Very good. And what is my sales? How much are my total sales?
It says in here that 616,250.
Very good.
But 29,000.
Yeah, very good. So our total revenue, we had 49,300 units at a price of $12.50. Very good. So it's 616,250. And we're going to do everything as a percentage of sales. So sales is 100%. Cost of goods sold is next. And again, we're subtracting it out. And we would have to calculate it, but we already did. We have that. So minus 431,400. What's our percentage there? Anyone have that yet? 70%. Very good. So cost of goods sold is 70% of sales. What is sales minus cost of goods sold? Very good. Gross margin. And how much is that?
184, 850.
Very good. 184,850. And of course, it would be 30%. So we have a gross margin of 30%. Okay. Again, this is a pretty simple income statement. So the only thing we take out next are operating expenses, which they gave us. So we had selling expenses of 26,000. Oops, I'm adding too many zeros. And administrative expenses of 134,000. So my total operating expenses, I'm going to show as a negative 160,000. So what percentage is my expenses of my sales?
25.9.
Very good, 25.96%. And then what is my operating income?
24,000.
Very good, 24,850. And what percentage is my operating income of sales?
4.0.
Very good, 4.03%. Okay. So again, we use this income statement for internal use, but it helps us look at, our margin, our gross margin, which is really important, cost of goods sold, both numbers and percentage-wise, and kind of see how we're doing. So we'd obviously compare this to past years and see how things were going. So the what if on this one says, what if the cost of goods sold percentage for the past few years was 65%? And so now it's jumped to 70%. What would management's reaction be, possibly? Investigate. Very good. We don't like to see cost of goods sold increasing. So the whole purpose of these, if we're doing this, projection and looking, it's like, okay, well, we just identified that there's an issue. So we compare it and say, okay, why did my cost of goods sold go up? Okay. And of course, that could be based on a lot of different factors. So we would want to investigate that. Any questions so far on any of the statements or costs or anything? All righty. 2 left, 4 down, 2 to go, right? Cost of goods manufactured and sold. So as you can see on this one, we're really just going through and doing another example. We just have new information. LeMans Company produces specialty papers at its Fox Run plant. At the beginning of June, it gives us all of our beginning inventories. During June, labor costs was $143,000, materials $346,000, overhead $375,800. Gives us ending inventories. So what we're going to do, truly, is just prepare the same 2 statements we just prepared. Okay, so it's just more practice. So again, we could put it, do you guys want me to do the T accounts? Okay. We can put it in our T accounts as we go along. Try not to erase everything here, right? I need to clean this board. It's so dirty. Okay. So again, I can just start by putting in all the variables I know, all the knowns. So materials, dry materials was $62,400. Purchases were $346,000. And ending was $63,000. Work in process started with $33,900. We don't know materials yet, but we do know labor was $143,000. And overhead $375,800. And then ending was $37,500. Finished goods, we had a beginning of 55,600 and an ending of 50,800. Okay. So there we've kind of set up all of our T accounts with what they gave us. So on this one, since we're doing a cost of goods manufactured and cost of goods sold, we need to balance all three of them. So what do I need to do on my materials to get materials used?
Labor and overhead, right?
That's when we get to our work in process.
Okay.
So yeah, we're in materials.
As purchases, you get a balance, so minus ending.
Very good. We're going to add up our debits, right? Our beginning balance plus purchases. So we'll add those two up. 408,400. So beginning balance plus purchases, 408,400. Subtract out that ending balance. So how many materials did we use in this period?
345,400.
Perfect. 345,400. Okay. So now we've balanced materials, and that 345,400 can come over here. And we do a balance of that account, right? So we would add up our total manufacturing costs. So direct materials plus labor plus overhead. Total manufacturing costs are $864,200. $864,200. Then we know we're going to add in our beginning balance and subtract out the ending balance. So what is my cost of goods manufactured?
860,000.
Got it, perfect, yeah. 860,600. Great. And where does that cost go? Where does that flow into? What account? Finished goods. There you go. Okay, so that comes into here. Lots of numbers, right? And then we just do our balancing of our finished goods. So we need to calculate the total cost of goods available for sale. So we add those two together. 916,200. And subtract out the ending balance. So my cost of goods sold is 865,400. Okay. Any questions on the T accounts? All right, so then all we're doing is putting them into our statement, right? So materials, we had beginning inventory, 62,400, plus purchases, 346,000. So materials available are 408,400. We then subtracted out our ending balance, less ending inventory. And that gave us materials used in production, 345,400. Then we're going into our work in process account. So we need to add in labor, 143,000. We add in overhead, 375,800. Whoops, not typing. 375,800. We added those up. We got 864,200. From there, we added in our beginning work in process. $33,900. And we subtracted out our ending work in process, minus $37,500. Cost of goods manufactured, $860,600. Everything matches up. And then when I scroll down, I'm going to take that number and put it into my cost of goods sold. So on my statement of cost of goods sold, I start with cost of goods manufactured, $860,600. And now I'm just balancing my finished goods account. So I add in my beginning balance, beginning finished goods, $55,600. I add those two together to get my cost of goods available for sale, which was $916,200. $916,200. And then I subtract out my ending finished goods inventory of $50,800. Cost of goods sold was $865,400. Lots of numbers, right? Do y'all dream in numbers too sometimes? You know, after you've been doing all these calculations, just wake up in the middle of the night and yell out some random. Or is that just me?
Just you.
I figured I'm special. I'll embrace it. Any questions on that one? It's really just what we've done in the other two, just getting it all together there. All the T accounts. All right. Well, now we're on our last one. We're going to do a statement of cost of goods sold. So it's just going to be kind of, again, just in a little different information this time. So they've given us Killdeer Company makes easels for artists. During the last calendar year, a total of 30,000 easels were made, and 31,000 were sold for $52 each. And then they give us the breakdown of our total unit cost. So there's our cost per unit, materials, labor, variable, and fixed overhead. They tell us selling expenses consisted of a commission of $1.30 per unit sold, and advertising co-payments totaling $95,000, administrative $183,000. There were no beginning and ending work in process inventories. Well, that makes life easier. Beginning finished goods inventory was $132,600 for the 3,400 easels that were in beginning finished goods. So a lot of information, right? But we'll break it down piece by piece. So the first thing they want us to do is just calculate the number and the dollar value of easels in the ending finished goods inventory. Well, first we want to calculate the ending units. We'll go ahead and use our little finished goods inventory here. Well, they told us that beginning finished goods inventory was 3,400 units, right? How many units did we make additional in the year? 30,000. Very good. So that just means that this is just in units. So we have 30,000 added in. So all total available units, we had 33,400. How many were sold? How many did we sell?
31.
Yeah, very good. 31,000 were sold. So to get how many were ending inventory, I would just take 33,400 minus 31,000, right? 2,400. And again, that's in units. So we have 2,400 units in ending inventory.
Well, then you made that a lot easier. I spent a little bit of time on this.
It's like, oh no. Yeah, that's why I always like just go back to your T accounts and put in what you know, and yeah, it makes it easier. Because when you sit there and like you start trying to do all the different things, and it's like that didn't work. We'll try a different number, right?
They didn't show us how to do T account.
Which I don't know why. It's like T accounts are great. So. And so then, what's the dollar amount in ending inventory?
Would it be the 39 times the 2,400?
Yeah, you got it. Well, they told us our unit cost was $39, so 2,400 times 39, 93,600.
Yeah, I was kind of going crazy trying to figure that out, and so is our chair.
April, yeah, she's like, I don't know. Cost. Yeah, sometimes they make it harder than it should be. You know, it's like.
We do too. We try and complicate things.
Oh, I do it too. There's times when I sit down in my office, and that's why I work all these before I come to class. So if I'm like, oh, I don't know that one, we won't do that one. We won't assign that one if I can't do it, right? Not that that ever happens. Yeah. So they want us to prepare cost of goods sold. So it's really the same, you know, we're going to start with our cost of goods manufactured. Well, the good news is they told us we had no beginning or ending work in process inventories, so we don't have to go through all this rigmarole to calculate it. We just have to look at, well, cost of goods manufactured, how many units did we make in this year? 30,000, right? It tells us a total of 30,000 easels were made. So what's my cost of goods manufactured then?
1,170,000.
Very good. 1,170,000. And we got that because we know we made 30,000 easels, and we know the unit cost is $39 per easel. So 30,000 times $39. Well, we know, and that's like what right here. That's what we're looking at, these 30,000. So that's the 1,170,000. Well, the next thing we need to look at, beginning inventory, we need to add in our beginning finished goods inventory. Well, it was 3,400 at $39. So that would be what, 132,600?
Beginning finished goods inventory at 132,600.
Yes. Yep, you got it. 132,600. So then we just add to get our cost of goods available for sale. 1,302,600. And then we subtract out our ending inventory less ending inventory. Well, we already calculated that. That was the 93,600. 93,600. So cost of goods sold is 1,209,000. So the moral of this exercise is it's so much easier when we don't have beginning and ending work in process. But that's very rare. Okay. Any questions on that so far? So then it just says prepare an absorption costing income statement, and then we want to show dollar amounts entered as percentages for sales. So absorption costing is the same as full costing. It's just sales minus cost of goods sold equals gross margin. So like the one we did previously, they just called it an absorption costing income statement, which makes sense when we talk about variable costing later. So we always start with sales. How many easels did we sell?
3,100.
Yeah, 31,000. 31,000. What was our sales price?
3,900.
$52.
52.
Yeah. So what is my total sales? Very good. And what is that? You're like, oh, I didn't calculate it, but you're right though. Yeah.
It's 30.
31,000 times $52, right?
Times 52. I have the right answer. Let's see, 1,612,000.
Very good. 1,612,000. And again, that's 100%. What's my cost of goods sold? How much?
1,302,600.
Oh, no, that's never mind, that's.
Oh, that was the total available. Yeah. Cost of goods sold.
3,600.
It's this one right here. Like we up here, like cost of goods sold. Yeah. So it's the 1,209,000. So yeah, the good news is we don't have to recalculate it. We actually have that. So minus 1,209,000. 75%. Very good. So that's 75% of sales. And so what's my gross margin?
403,000.
Very good. 403,000. And of course, that would make it 25%. So we have sales minus cost of goods sold, and we have our gross margin. Then we just take out our operating expenses. Well, they told us commissions were $1.30 per unit. So if we sold 31,000 units, what's my total commission?
40,300.
Very good, 40,300. So again, that was the $1.30 times 31 units sold. And then the other two are truly given. Advertising copays, 95,000. And administrative expenses, 183,000. I add up my total operating expenses, 318,300. 318,300. And it should be 19.75%. So I have an operating income or an operating loss? Income, good. And how much income did I make?
84,700.
Very good. 84,700, which is 5.25% of sales. Okay. So that's our income statement. Again, they call it the absorption costing income statement, which is just a normal income statement that we're used to. When we get into later chapters, we'll do variable costing. So we'll have variable income statements. So that's why they're just kind of identifying that as an absorption. So that's when we're considering an absorption cost, or an absorption costing income statement is considering all of our product costs in this margin here. So cost of goods sold is both variable and fixed costs associated with it. The absorption costing is also known as full costing. Any questions? It's a lot of number crunching, right? And T accounting. Alrighty, well, if there's no questions, just remember next week we'll start chapter 3. So do your chapter 3 adaptive learning plan, and then your chapter 2 homework will be due next week. So be working on chapter 2 homework, and it'll be due next Wednesday after class, like Wednesday night. So if y'all have questions you run into, you can email me. But if it's something you want to go over in class, we can spend a little time next class period with any questions.